Markets are on a roller coaster today. Huge volatility, massive whiplash, and a genuine sense of unease in every corner. But what's behind all this market mayhem? Let's break it down. Right now, everything is shaking. The driving force behind today's chaos is Moody's, the respected global credit ratings agency, which has just downgraded the United States credit rating from its gold standard AAA to AA1. This downgrade wasn't made lightly. Moody's cited the skyrocketing budget deficit, rising interest payments on the national debt, and the brutal pressure of today's high interest rate climate as key factors behind this decision. Remember, this isn't just an isolated incident. The US has already lost its pristine rating from the other two major rating institutions. Standard & Poor's dropped it back in 2011, and Fitch trimmed it further in August 2023. With Moody's now joining the fray, the message is loud and clear. Even the world's biggest economy isn't invincible. The aftermath and market reaction. So why all the whiplash? When headlines like this hit, markets jump into a panic. But don't be fooled by the initial shock. The bond market and institutional players had already factored in the possibility of these downgrades a long time ago. What we're witnessing today is more of a confirmation of a trend rather than a brand new crisis. This news has naturally led to increased market volatility. Traders and investors are reacting to what they see as a tipping point. Even though the headline appears ominous, there's more nuance here. Many experts are pointing out that this downgrade was essentially a lagging indicator. In other words, it's confirming what the market had already priced in over previous years. The crypto angle. Why Bitcoin benefits. Now here's the twist. While the downgrade might sound like bad news, it actually serves to further underscore why an asset like Bitcoin is so vital. In times of economic uncertainty, the appeal of a non-sovereign, decentralized asset grows even stronger. Bitcoin, as a digital gold, offers an alternative to traditional fiat currencies that are subject to government policies and fiscal missteps. Industry voices like Tom Lee of Fundstrat have even described today's reaction as a buying opportunity. According to him, the signal from Moody's doesn't come with any groundbreaking new information. It's just a formal nod to what was already expected. In fact, he anticipates that despite today's jitters, the market pullback might be very shallow. There's even a chance we close out the day in positive territory, especially when you consider that a lot of retail investors dumped their holdings during the downturn earlier in the year. Inflow of cash and investment sentiment. Think about it. About $7 trillion in cash is just waiting on the sidelines. Institutional clients and skeptical investors from across the globe are sitting on piles of money, ready for the market to rebound. When the dust settles, that cash will start chasing the next rally. And for crypto enthusiasts, this is a win-win moment. When traditional markets are rattled by credit downgrades and political drama, the shift towards alternative assets like Bitcoin becomes even more pronounced. This isn't just theory, it's a realignment of money flows, and it highlights how precious crypto has become as a hedge against systemic risk. Government legislation, a game changer for crypto. There's another reason to be optimistic about crypto right now. Two major pieces of legislation are making their way through Congress, and they're set to open a floodgate of capital into the US digital asset market. The first is the Market Structure Bill. This proposed law aims to establish a comprehensive regulatory framework that governs all aspects of digital asset markets, from exchanges to brokers to various other intermediaries. The bill will clearly define what digital assets are, set out which jurisdiction has authority, be it the SEC or the CFTC, and eliminate a lot of the uncertainty that has plagued the industry. With the US being the largest capital market in the world, such a framework could bring tremendous clarity and legitimacy to crypto investments. The second legislative push comes in the form of a stablecoin bill. Recently, a stablecoin bill did not pass its first vote in Congress, but that's not the end of the story. Lawmakers are reintroducing it with renewed vigor. This bill would carve out clear rules for stablecoins, those digital tokens backed either by the US dollar or by short-term treasury securities. Essentially, it will lay down the legal groundwork, ensuring that these digital dollars operate with full transparency and safety. Senator Bill Hagerty, one of the leading voices on this initiative, emphasizes that stablecoins are not just another speculative asset, they're a new payment system. By establishing solid regulatory clarity, the US can finally invite a superior digital payments technology to thrive, one that dramatically outperforms the old systems designed in the 70s and 80s, the floodgates of the future. With these bills on the horizon, we're looking at a fundamental shift in how the market works. For years, the crypto space operated under a cloud of uncertainty. Fear of enforcement actions and ambiguous guidelines from the SEC kept many investors on edge. Now, with legislation that's clear and targeted, the environment is set to become much friendlier. Think of it like this. The floodgates have been slowly creaking open since the launch of BlackRock's ETF in 2024 and the transformative political moves that started in 2025. Now, with a clear regulatory path in sight, those floodgates are about to swing wide open, allowing an enormous influx of capital into the digital asset market. Yet, there's a fascinating paradox here. While 95% of Bitcoin is already in the hands of investors, a staggering 95% of investable cash still hasn't touched it. That gap represents a colossal opportunity. When large institutional players and sovereign wealth funds, those controlling tens or hundreds of billions, start buying Bitcoin in earnest, it could drive the asset to levels we haven't seen before. Michael Saylor nails it when he describes the situation as a kind of IQ test for investors. If you had $1 billion and wanted to double it, you might simply buy $1 billion of Bitcoin and announce it. But if you're aiming to turn that billion into $1 trillion, you need a strategy that's more aggressive and sophisticated. The idea isn't far-fetched. With borrowing costs as low as 3 to 5% and opportunities to invest at returns between 30 to 60%, the potential upside for leveraging Bitcoin is enormous. Bitcoin, the asset class of the future. Let's zoom in on Bitcoin for a minute. More experts are affirming that Bitcoin is now a bona fide asset class. Anthony Scaramucci from Skybridge Capital recently made a powerful case. If Bitcoin qualifies as an asset class, then institutional portfolio managers will soon have no choice but to allocate a significant portion of their assets into it, just as they do with gold, Amazon, or Nvidia. Look at the distribution of Bitcoin ownership. It's incredibly global. In contrast, companies in the S&P 500 are mostly held by Americans. Bitcoin's widespread adoption across borders gives it a unique edge that reinforces its value as a global store of value. For instance, if 50 to 60% of current Bitcoin holders continue to see it as a long-term asset, the standard price target of $200K per Bitcoin might actually be an understatement. Some even predict that as demand continues to outpace supply, prices could surge far beyond this level. In fact, I now believe that crossing from 110K to 125K could happen very rapidly, opening the door for a swift move to those higher levels. So here's the bottom line. Yes, Moody's downgrade is headline-grabbing and momentarily unsettling for the markets. But underneath the surface, it's confirming a trend that many have seen coming for years. It underscores the fact that traditional systems and their ratings might be failing to capture the evolving economic landscape, which in turn makes decentralized assets, like Bitcoin, all the more attractive. The upcoming legislative changes could radically transform the digital asset market by providing the much-needed regulatory clarity. And with institutional cash on the sidelines ready to be deployed, we're looking at an environment where high highs are not just possible, but probable. As the market digests these changes, keep an eye on how these events unlock further gains. In this rapidly evolving market, every dip is just an opportunity waiting to be seized. The future of crypto is being written right now, and if you stay informed and ready to act, you could be a part of something huge. That's the long and short of it. Stay sharp, keep learning, and remember, in times of volatility, the smart money is always looking for the next clear signal, and the next breakthrough is just around the corner. If you want to stay ahead in this crazy crypto game, don't miss out. Hit that subscribe button right now. Trust me, you'll want to be here for what's coming next.